Stock buybacks have been a hot topic recently.
President Biden expected to hit the higher taxes on stock buybacks theme pretty hard today.
In 2022, President Biden signed a new tax into law which would tax corporate buybacks as a way to generate some tax dollars but also slow down corporate buybacks. We broke a record for corporate stock buybacks in 2021. And then we broke that record again in 2022, and even with the new tax law in effect, it looks like we might break that record again in 2023. This has put more pressure on President Biden to raise the tax on stock buybacks again as a way to slow down corporate buybacks even more and hopefully generate some more tax dollars as well. The real question I want you to understand though is, should we be discouraging corporate buybacks or should we be encouraging them? If you remember, back in 2007, we also broke a record for corporate stock buybacks that year, and then 2008 came, the financial crisis started, and companies didn't have any money left. On the flip side, if you're investing your money for retirement, if you have money in the stock market, if you have a 401k or an IRA, stock buybacks are a good thing because that means your stock portfolio and your investment portfolio and your retirement portfolio is growing faster because stock buybacks cause stock prices to rise. Even Warren Buffett came out publicly in 2023 and spoke on stock buybacks, and he said, if you're criticizing stock buybacks, you're either, quote, an economic illiterate or a silver-tongued demagogue. Now, while most people have a strong opinion either for or against stock buybacks, I don't think most people really have a good grasp of understanding what stock buybacks are and their implications of stock buybacks on the company and the economy. So let me start by breaking that down first with a very brief analysis over what stock buybacks are. Let's assume that this hypothetical company did $1 billion worth of revenue, and then they have, let's just say, $500 million worth of expenses, which means that they have a profit of $500 million. Now, when they have this $500 million profit, this $500 million sitting in the bank account, and then they have three things that they can potentially do with this cash. Option number one is they can save this money. Option number two is they can invest this $500 million back into the company. They can hire more employees, invest it in advertising, open more stores, invest in more manufacturing. Or option number three is they can give this money away to their shareholders. One way they can do that is a stock buyback. Another way they can do that is through a dividend. Now, option number one, which is saving the money, is actually the least attractive option for corporations because of the way that our tax code works. Our tax code will tax you if you save that money because that means that this money is your profit. You're taxed on your profit. And so now if this corporation has to pay a 21% tax on this profit, that means that they're going to have over $100 million going to the IRS, which leaves them with only $400 million. And now you might think, but $400 million is still a lot of money. Sure. But if you are running this company, $100 million can go a long way. You could use the money to hire more employees. You could use the money to open a new store. You can use the money to invest in more infrastructure. You can use the money to raise your employees' salaries. You can do a lot of things with this money, which is why so many corporations don't like saving all of this money because there's a very expensive cost to save that money. And so many corporations will opt out to saving a lot of money. Then option number two is investing this money back into the company. You'll see employees then do what I just said. Invest in more stores, more manufacturing, more whatever. That way they're putting this money back into the company. And if this company can spend all $500 million, maybe they spend it on a new advertising campaign or whatever. If they spend all $500 million, now they have $0 of taxable income and $0 of tax bill. And then they were able to use this $500 million more productively because they put this money back to work in the company, versus here, this is not being used productively because now $100 million went to the IRS. So it's not productive for the company because this company isn't getting the same benefit than if they took this $500 million and put it back into the company. Then option number three is they can take this money and they can give it away to the shareholders. So this company, let's assume, is a publicly traded company, meaning it trades on the stock market. That means this company is owned by the shareholders. If you go out and you buy one share of the Amazon Corporation, you become one of the owners of Amazon. Now, you might be owning the Amazon stock and say, you know what, I've been owning this company for a long time. I want to be rewarded for my ownership. Now, how do you get rewarded? Well, they can just give this as a cash payment to everybody for you owning the company. That's called a dividend. So now they can just distribute this money to the owners. Or they can take this money and they can buy back their own stock. Now, a stock price is determined by supply and demand. That means when you have more buyers of a stock, the stock price goes up. So now if this company takes $400 million, because now you have to pay taxes on this money, and they use this money to go and buy back their own stock, now you have $400 million or $500 million going to buy the stock, which then causes stock price to go up, which now means that if you own the stock, you just made some money on paper. You don't actually make the money because, well, you have to sell your stock to actually make any money, but you saw your stock price now rise because this company just bought a whole bunch of stock, which then pushes the stock price higher, which means that your investment portfolio is higher, your 401k has grown, your retirement portfolio has grown. Your stock now is worth more money because now they bought some of the stock back. Now, if you sold the stock, well, now you have more of this money in your pocket, but in your portfolio right now, it shows that you just made some more money. Now, before I explain why this is so interesting, let me also mention taxes really briefly, because now when this corporation takes this $500 million worth of profit and now they want to buy back their own stock, well, first, the corporation is going to have to pay taxes on this money, which means that they're going to be left with just under $400 million, because right now at the time of recording, the corporate tax rate is 21%. So 21% of this money is going to go to the government. Just over $100 million goes to the government, which means they're left with just under $400 million. Now they can take this $400 million and go and buy back stock. But now we have this new 1% tax on corporate buybacks, which means that if the corporation buys $400 million worth of stock, 1% of this money is going to go in taxes. And then if you own stock, whether it's through your 401k or your retirement accounts or your stocks, now when you make money here and you sell your stocks for a profit, then you're going to have to pay taxes as well, because now, well, you made money. Now, the way you pay taxes is going to depend on where this money is. If it's in your 401k, well, it'll be taxed differently than if it's in your Robinhood account or your E-Trade account. And so it's going to be taxed very differently depending on how you're investing your money, because 401ks and IRAs have some special tax rules that they can follow as well. But just understand the tax levels. You pay taxes here when the corporation makes the money. Now you have to pay taxes when the corporation does a stock buyback. And then when you make money, whether it's through a dividend or when you sell your stock for a profit, you also pay taxes on that as well. Now, this is where things really start to get interesting, because what we've been seeing happen is corporations have this situation happen. They make $1 billion, they have $500 million worth of expenses, you have $500 million worth of profit, which then you pay taxes on. But instead of doing stock buybacks with $400 million, they say, you know what, we're gonna do something called a levered corporate buyback. We covered this pretty heavily in market briefs, so if you've joined market briefs, you should know what I'm talking about. But a levered corporate buyback is now where the corporation says, we have $400 million worth of profit. We can go to the bank and say, hey bank, we have this big profit, we have all these revenues, we have all these assets, can you give us a loan? And the bank will say, sure, we will give you a loan of $600 million. So this B is the bank gives you $600 million, and now instead of doing a $400 million corporate buyback, the corporation does a $1 billion corporate buyback, because now they're going into debt to do this corporate buyback. And now you have a 1% tax, not just on the $400 million, but then on the debt as well. And the reason why that's so interesting is because debt normally isn't taxable. This is what we talked about in Market Briefs. If you haven't joined Market Briefs, which is my free financial newsletter, I highly recommend you do so, because it's an easy way for you to stay up to date on what's happening in the top financial news. We cover what's happening in the economy, the stock market, the housing market, and everything you need to know as a retail investor. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, I'll put the link to how you can join down in the description below. If you went out and you borrowed $500,000 to buy a home, you're not paying taxes on the $500,000 that you're borrowing. And if you went out and you did a cash out refinance, where you pulled out $500,000 from your home, you're not paying taxes on the $500,000 that you're getting from a cash out refinance, because debt is not taxable. But what's happening here is you're getting the $600 million from the bank. It's not taxable. But now if you use the $600 million plus this $400 million to go and buy the stock, now this debt is being taxed, not because of the debt, but because of how you spend it. So now you have this 1% tax going on the full $1 billion, which is a way to discourage stock buybacks. Now you might be saying, no, the government's not trying to discourage stock buybacks. They just want to get some revenue from the stock buybacks. But you have to understand, why does the government tax things? Why does the government tax things like cigarettes and tobacco use? It's a way to discourage things that the government doesn't want to do. So it's a way to discourage stock buybacks and too much stock buybacks, because if corporations have to send a lot of money to the government, they might think twice before they do stock buybacks, and maybe they take this money and reinvest it back into the company. Let me give you a real-life example to really diagram this out. Facebook's parent company Meta made just under $29 billion in 2022, and this is from the Investors Relations page on the Meta website. So in 2022, Facebook's parent company Meta made just under $29 billion, and then in the early part of 2023, Meta announced that they're going to do a $40 billion buyback. So how are they going to fund a $40 billion buyback when they only made $29 billion last year? Well, they're going to use the help of debt to now fund this $40 billion buyback, which is called a levered corporate buyback. But why does a corporation do corporate buybacks in the first place? Can't they use this money for something better, like invest it back into the company? Well, this has to go to something called corporate governance. This is how the corporate ladder looks in most companies. Something like this. Every company is going to have their own variation, but at the bottom you have analysts and associates and VPs and directors, then your CEO level of executives like your CEOs. But then on the side, you also have the shareholders. These are the people that own the company. Now, if this is a publicly traded company, these shareholders can be regular people like you and me. But this can also be the people that work in the company. Many times you're going to see CEOs and other C-level executives get some form of shares or equity in a company. Many times also you'll see people like here and here also get shares in a company. And then in some companies you'll also have associates and analysts also getting shares in a company. So who's the owner of the company? Well, this could be really anybody depending on what the company is. Now, the shareholders want to see the price of their stock go up because they get paid not with a salary. These are people that are getting paid for owning the company. So they get paid when the company makes more money. Now, this happens when the company makes more money and more people want to invest in the company, or if the corporation does buybacks, which then also boosts the stock price. So shareholders want to see the stock price go up. People who own the stock in the 401k want to see the stock go up. People who invest in this money on their own want to see the stock go up. So now the shareholders are saying, hey, CEO, we own this company. You, the CEO, work for us. You have to drive up the value of the company. One way that they do that is then they tell everybody to work, to improve their efficiencies, to make more money, to do things in the company that will help the company become more valuable. The second thing that they can do is say, hey CEO, we see that we made a lot of money this year. How about now we take some of this money and we use it to buy back the stock, because that's the way to make the shareholders richer. Because now when the corporations take their money and they buy back stock or they do dividends, this money is going to the shareholders. It's not going inside of the company. It's a way to enrich the investors who own a piece of the company. See, this is where we really have to match intentions with education, because everybody wants to see their investment portfolio grow. Everybody wants to see their retirement portfolio grow, and the government has been incentivizing people to invest in something like their 401k, because that's the way for people to be able to fund their own retirement and not just rely on social media. And in order for your 401k and a retirement account to grow, you need your stock prices to grow as well, because if stock prices rise, your investment portfolios rise. So in this instance, stock buybacks benefit people because now your retirement portfolios rise as well. But the reason why stock buybacks end up getting so much heat is because they get abused sometimes. We remember what happened in 2007. In 2007, we saw a record amount of stock buybacks. Corporations were doing stock buybacks hand over fist, and then came 2008. The market burst. The whole financial market started coming down, and now corporations didn't have any money to protect themselves because they spent all their money on corporate buybacks, enriching the investors, which meant they had no money to protect against layoffs. They had no money to protect their company against a bankruptcy, and then the whole financial system almost imploded. Now, this is one of those things that isn't a very attractive answer, but it's the financially educated answer, that stock buybacks are good until they become bad. Like most things, too much of a good thing can be a bad thing, and where most people are saying either stock buybacks are horrible and they're destroying America, or other people are saying stock buybacks are amazing, there's always a balance to things where it's good versus bad. Stock buybacks encourage people to invest and see their investment portfolios grow, but when a corporation does too much stock buybacks, they go way too deep into debt to fund their corporate buybacks. Now they're going to be using their future incomes not to grow the company, but to pay off the previous corporate buybacks, which creates opportunity for a new company to come in and undercut that first company. So stock buybacks have their place, but when a corporation overdoes it, they can shoot themselves in the foot. The reason why this becomes a problem then is because then people pay the price, whether it be through layoffs or through a bankruptcy. And then if the government has to come in and bail out the company by using taxpayers' dollars to bail out a company that did way too many corporate buybacks, you can see why people get upset, because now a corporation enriched the investors, they made all the investors rich, and then the company went bankrupt because they didn't use the money the right way, and then the government uses tax dollars to bail out the company. Which is why we shouldn't be bailing out companies. We have to let the companies fail. That way a company can learn, and that way then companies will be more likely to be smarter with their corporate buybacks, because if they realize that if they screw up, they won't be bailed out by the government, then they'll have to be a little bit smarter with the way that they use their money and be more protectionary with the money that they have, and not overdo the corporate buybacks. Because if you don't have that fear, if you always have that insurance that no matter what happens, you're going to have somebody else bail you out or give you a huge check, then what's your incentive not to be risky with your money? See, our entire economic system is intertwined together because everything is built up by people. Corporations aren't a separate thing that run by themselves. They're run by people. And our government isn't this thing that is self-funded and it has its own income. It's funded by people and tax dollars. So everything is intertwined together, and this is why financial education is so important. That way we can understand how the different parts play into one another instead of just hating one thing, because when you hate one thing, well, it can shoot you in the foot somewhere else. Like when people talk about raising corporate taxes, that isn't taxing just the corporation. It taxes people as well, because a corporation is made up by people. And so understanding how the different parts of our economic system are intertwined with one another is one of those basic levels of financial education that we should have all been taught, but most of us are never taught this. What happens if you're getting close to your retirement age and then a recession hits? Then what? We saw this happen before the 2008 crash. We saw this again in the 2020 crash, where the market crashed and people were selling out of their retirement accounts at huge losses. But what if you could get paid while you wait for your investments to grow in value? That's exactly what you get when you